Who would have thought that 2024 would turn into such a great year for investors? Since global stock market indices are currently passing one all-time high after another, we're seeing what usually happens in this situation. More and more investors are asking, since the market has gone up so much, is now the right time to buy ETFs or should I wait for a drop first? The exact same goes for Bitcoin. Now that it's getting closer and closer to $100,000, all of a sudden everyone seems interested again and is wondering if now is a good time to add this volatile asset to their portfolio. And lastly, the ECB has another monetary policy meeting this month, so we may be looking at another drop in euro interest rates before the end of the year. We'll discuss what this means for high-yield savings account as well as popular money market ETFs. So as you can see, there's a lot to talk about today. I'll of course also show you how all of my investments performed until today, December 1st, and how I'm planning to rebalance a bit before the year ends. Let's start with stocks in the form of ETFs, by far the largest position of the investment portfolio I share with my wife. The Invesco FTSE World, the global ETF we buy on a monthly basis, finished November up an astounding 7.11%. To put this into perspective, 7% is the average yearly return I like to calculate with for our long-term investments in ETFs, which means it's now up 26.29% in 2024 as a whole. Looking at actual numbers in euros, our ETF portfolio has gained 26,200 euros in November and 75,600 euros since the start of the year. As for our average yearly return since we started investing in ETFs back in 2017, we're currently sitting at 12.22% per year. I really did not expect the stock market to perform this well in 2024, especially after we had already rallied 18% in 2023. I actually anticipated lower returns compared to last year. Of course, this could always turn around in December, we'll have to wait and see. But so far things have been great for investors in world ETFs. Which is why I'm now seeing this age-old question pop up more and more often in comments and emails. Is now a good time to buy ETFs since the market has gone up so much? Or should I wait for a drop first? It's completely normal to feel that way. I've been in that same exact position many times before myself. We also have analysts telling investors to wave goodbye to the stock market's historic run based on their forecasts. That sounds pretty bad, right? Well, that's until we take a look at forecasts from the past and what happened in reality. The average Wall Street forecast was that the S&P 500 would finish the year at 4,861 points, or that US stock market returns would basically be flat for the year. And yet, here we are at the start of December with the S&P 500 above 6,000 points, 24% higher than what experts predicted. The thing is, nobody can successfully predict how the stock market is going to move, and so-called experts are no exception. In fact, from the year 2000 to 2023, the median Wall Street forecast missed the actual end of the year returns by 13.8% annually, more than double the average yearly returns in the market. This means that listening to expert advice was essentially worthless, and that's unlikely to change going forward. Well, Goldman Sachs is now calling for 10% returns in 2025 for the S&P 500. Take that however you want. Hopefully we don't see the opposite happen based on their poor track record with forecasts so far. Either way, I still understand if you feel a bit worried after seeing the market pass one all-time high after another. That part in itself shouldn't deter you from investing though. Since the market trends upwards over time, it's completely normal for it to reach new all-time highs on a regular basis. Looking at the US stock market specifically, it has on average made 14 new highs every year since 1928. I'm not saying we couldn't see a correction soon. After all, pullbacks, corrections and even crashes every couple of years are a normal part of investing in the stock market. And we may be overdue for a correction since the market has gone up so much the past 2 years. The thing is, there's no way to know if and when it's going to occur and how long it will last. It's not something to be afraid of though, otherwise you'll end up standing on the sidelines indefinitely and you'll never end up investing any of your money. There's always something to worry about next if you're looking for it. As long as you have a long enough time horizon of at least 5 years, ideally 10 years or more when investing in ETFs, it's not going to make too much of a difference anyway. If we do get a correction, you'll be able to buy additional shares of the most productive companies from all across the world at a lower price. And if we don't, you'll be happy that you didn't wait before investing. It's impossible to predict what's going to happen in the short term, so don't overthink it, zoom out and focus on your long-term financial goals. Speaking of long-term investing, you can find the best local brokers in Europe for ETFs linked down below, which is a great way to support me if you'd like to. And don't forget to subscribe if you haven't yet. Now, the ECB has another monetary policy meeting planned for the 12th of December, and it's highly likely we may see another drop in euro interest rates by the end of the year. My wife and I are still using the German bank and broker Trade Republic as our own high-yield savings account, since they're committed to pass on the exact ECB rate of currently 3.25% one-to-one to their users. In November, we earned an extra 78 euros in interest with them, bringing the total to 1,051 euros so far. We're also still using the Trade Republic card, where we earned an extra 15 euro due to the 1% Saveback we get on all of our expenses using the card. I'm fully expecting the European Central Bank to lower rates to 3% by the end of the year, which means both money market funds like the popular X-Trackers Euro Overnight Rate Swap, as well as insured savings accounts like the one offered by Trade Republic, will start paying that rate as well at that point. And sadly, based on Vanguard's economic outlook, we could be looking at rates as low as 1.75% in the euro area by the end of 2025. So let's enjoy our interest rate of 3% or more for as long as it lasts, as it seems likely we'll be back to much lower numbers within 12 months. And hopefully inflation will remain at reasonable levels, since that could obviously change things. Alright, let's get to my small allocation to Bitcoin, which just had one of the craziest months I've experienced since 2017. It went up 42% in November and is now up 139% since the start of 2024, which makes it my best performing investment this year by far. Now here's my main concern whenever I talk about Bitcoin. I don't want anyone, but especially investors that are just starting out, to see this and then make the wrong decision based on its high average return so far. Forget about ETFs and their measly returns. I'm going all in on Bitcoin. Please don't do that. Bitcoin carries a ton of risk and should not be the foundation of your retirement strategy. Based on my own 7-year experience as an investor holding the digital asset, I do believe it can be a great addition to a diversified portfolio, but in my opinion you should still limit it to a small percentage of your investments. I'm aiming for an allocation of around 10% long term, which I'm willing to leave untouched to a maximum of 25% during bull markets like the one we're currently in, before rebalancing the amount back down to more reasonable levels. Finding the right time to do that is a science in itself though, and you'll just have to accept that you'll never hit it perfectly. I'm planning my next rebalancing at the end of this year. I wouldn't recommend allocating that much to Bitcoin to 99% of investors though. 1% to a maximum of 10% of your portfolio is plenty. And I also want to clarify, it's perfectly fine to exclude Bitcoin from your investments completely. It's not for everyone and it carries a ton of risk. This means that unlike world ETFs, Bitcoin could theoretically go to zero. You should always factor this into your decision making. Anyway, now that it's closing in on $100,000, I'm noticing more and more people are suddenly interested in it again after calling it dead so many times before. Now, that in itself is fine. It happens every market cycle when Bitcoin goes up quickly. I would simply recommend you keep the following 3 things in mind. First, you should be willing to hold it for at least 4 years, the length of one full Bitcoin halving cycle. That's because historically, Bitcoin tends to crash as much as 80% in value during bear markets before recovering. Second, buy it on a trusted exchange like Bitvavo, my personal favorite with the lowest fees in Europe, or Bitpanda, Kraken and Coinbase, which I also consider great options but with higher fees. And third, if you hold over 1,000 euros worth of Bitcoin or other crypto, I would strongly consider buying a hardware wallet like the Trezor Safe 3, which is what I like to use, and moving your Bitcoin there for extra protection. Only buy it from the official store for security reasons, and please never share your seed phrase with anyone once you move to a hardware wallet, since they otherwise get full access to your funds. And if all of that sounds way too complicated for you, you can always just add a bit of Bitcoin using a broker like Trade Republic. Just be aware that you'll be paying a 0.5% higher price when buying, and that you won't be able to move your Bitcoin anywhere else from there. As for our investment strategy, it pretty much remains unchanged. 90% is still going into a single ETF, the accumulating Invesco FTSE All-World, every single month, no matter what markets are doing. If there's a correction, then great, we'll be happy to buy at a discount. While if it keeps going up, then we'll also be happy we didn't wait before investing. Meanwhile, the remaining 10% of our monthly savings are going into Bitcoin, with me planning to rebalance our assets again at the end of the year. Before I take off, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. If you'd like to support me, feel free to use my links in the description below to the best local brokers in Europe for ETFs and other financial tools I use. None of what I talked about today was of course meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. By the way, if you're wondering about all the financial mistakes we made and how our investment strategy changed over time since 2017, make sure you check out this recent video of mine. And if you want to see how much our expenses as a family of 3 have increased and how this impacts our early retirement goals, check out this one if you haven't seen it yet. Thank you guys so much for watching, have a wonderful day, and until next time.